Every day is a different drama with this war and with the market, and we were on a really good roll for a while. Then days like today, where we're down just a little, feels like, uh-oh, it's the start of something really bad, and that's how you catastrophize things. Just remember, though, we've come a long way in a short period of time. Um, but today we have Charlie Peabody, we have Bob Morris, we have me too to kind of offset those two positives. Charlie, let's talk a little bit about what's going on. I think you sent around a chart that you wanted to talk about housing, but also some other stuff. So what do you have for us today?
Well, a potpourri of things. Potpourri. um, so, listen, bank stocks have acted very poorly. And, if you look at something like Wells Fargo, which used to be a favorite the last 3 or 5 years, it's down 19% year to date in a market that's up 8. And so I'm wondering, and the lead steer of this group, JP Morgan, which is the best franchise, best management, best balance sheet, et cetera, is also down year to date. So you have to take note when, big, liquid, well-owned banks start performing poorly. And so in the last couple of weeks, last month, I've been writing about why I think banks are going to roll over. And it's largely because we're at what we call peak PPNR, pre-tax, pre-provision net revenues, PPNR. And essentially what that is total revenues minus operating expenses, but not minus credit costs. So total revenues minus operating expenses. And that, is growing at a mid-teen rate year over year. And it's probably been the best metric that coincidentally um, measures up to how stocks perform in my industry of banking. So when PPNR peaks, bank stocks peak, and that was up about 15% in the first quarter year over year. It's probably going to be up anywhere from 12 to 15% here in the second quarter. So another really good second quarter. But bank stocks are selling off into that, and it's in my mind, it's because in the second half of the year, we're going to see that PPNR rate of growth drop dramatically. And as we exit 2026, we're going to see PPNR growing at a mid-single digit rate. So not a lot of cushion in terms of net revenue growth in this as you exit this year. So the question is, what's going to happen to credit quality? And if we are starting to see corporate credit quality deteriorate here, then credit costs in the second half of the year are going to start to rise because they've been pretty benign so far. And if they rise at a time that PPNR is slowing, then you've seen peak earnings in my industry, and that's been my case. Everyone was very, very bullish on banks coming into the year, saying deregulations could lead to multiple expansion and earnings growth, et cetera. And I've been a contrarian on that and saying, I think it's time to sell your bank stocks. Um, so I think that dynamic is what's starting to filter into investors' minds. I bring this up because over the next 3 to 4 weeks, we're going to have three different banking conferences, one starting today over the next 3 days, one at the end of May, and one in June. And we're going to start to get some updates from management as to how they're viewing the year. And there are two very important revenue metrics that are going to get looked at. One is spread income, what we call net interest income or top line revenues. And at the beginning of the year, when they gave their forecast for spread income, they assumed, two rate cuts, mostly in the back half of the year. And that was supposed to help their NII growth. So if today we're taking rate cuts out, will we get updates from various banks about, NII not being as robust as anticipated? And I think that's largely what's behind Wells Fargo's underperformance. They're probably going to revise down their NII forecast. Earnings are probably going to come from, down from $7 to under 6.90, that kind of thing. So that's what the markets are starting to anticipate ahead of these various banking conferences. And then the second metric is capital markets revenues, things like trading, investment banking, wealth management. And here, I think expectations remain robust. In fact, if you look at Morgan Stanley, it's been making new highs. Goldman Sachs is still within striking distance of its new high. And the one regional bank that's done very well, Citizens Financial, has a big play on capital markets and wealth management. So that's the distinction I think the marketplace is making on the revenue side. Is capital markets, they still expect to be good. NII, they're concerned about, parebacks of guidance. So that's how you're seeing these stocks disperse, because there are stocks that have done well. I mean, Citigroup has done very well this year. They just had their investor day and put out some metrics for the next 3 and 5 years, and they were, I think they're achievable. So
Yeah, it's
that remains
interesting.
my number.
I saw someone say something about the Citibank. I think the CEO even said in a subsequent interview, someone said, "Well, it seems like you were sandbagging." They didn't use that phrase. They said it seemed like this was very conservative. And like, yeah, there's room to go higher. I was like, well, do you
Yeah,
think that's the case? I mean, do you think they were? Do you think it's a little bit? Is it below where you are for the year?
no, I wrote a report after that investor day called "Keeping It Real." And the analyst community did push management to say they were being too conservative in their targets. And the thing you have to understand is the upside to Citi is around things like investment banking, wealth management, and those are heavily dependent upon the capital markets remaining robust and asset prices rising. And it's hard, when you're at 74, 7,500 on the S&P, to think that prices can rise dramatically from here. Um, and if we are moving towards a credit cycle on the corporate side, it's hard to believe that credit quality is going to remain benign. And so I think management is much more realistic about the operating environment in 27, 28. I'm not talking about this year. I think this year is a lock, for a lot of these companies. But 27, 28, there's a lot of uncertainty when you start thinking about the macro environment and the capital markets. So I think they were being conservative. If we have a robust GDP growth, then those targets will be beat. But I'd rather them build their credibility, because for the last 2 decades they've had no credibility.
Hey, Charlie, when you talk about the banks rolling over, is it predominantly earnings have to come down, or is it a combination of earnings coming down and the multiple or percent of book that these stocks trade at coming down also because you've gotten past those peak earnings?
Yeah. So the multiple, these stocks, trade at 52% of the market multiple. So the market multiple is at the low end of the trading range. If you look at a price to book basis, they're trading at 2 to 3 times tangible book, which is at the upper end of historical ranges. So
Right.
obviously there's some disconnect, between there. And if we have a credit cycle, it's the earnings that are going to come down, and therefore the price to book will change dramatically. So I'm more concerned about the banks, and it's probably going to, you're not going to see anything to confirm my concerns until the second half of the year, because the second quarter is going to be very robust again. But I do think, there's a credit cycle developing there, and maybe that's why, they're buying the Goldman Sachs and the Morgan Stanleys, because there's no credit risk, or perceived to be no credit risk, and they're selling the Wells Fargo because there is a credit risk there. You know, it's interesting. People used to think that Wells Fargo would not have credit problems because they had the asset cap for the last 5 years and couldn't grow their balance sheet. Well, the last 2 quarters, they've had big jumps in their CNI, their corporate, problem asset pool. So that thesis is not playing out either. Um, but yeah, it, it's hard because, as I said, you're going to have a good first half, and you had a good first quarter, and the second quarter shaping up to be good. But it's the second half that I think the market is starting to worry about, if the credit cycle is turning on us.
Alrighty. You had a couple of slides. What were those all about?
I did, yeah. I was just going to mention housing, because I've been on this kick since the fall of 24, saying, you know, affordability is going to be a big problem to get housing sold, and so I've been negative
Wait,
on the
is this a
home
chart of Bob Morris's house price?
um, it's more like my house price, which I don't own anymore, but thank God. No, so we had yesterday, total existing home sales for the month of April, and they came in at 4.02 million. And you can see on this chart for the last 3 years, home sales have been absolutely flat around 4 million. And that's a problem for the economy. And it's surprising to me that Trump and his administration are not doing more to try and improve housing, because it is has a multiplier effect on the economy. So you would think going into an election year he would come up with some policies, but he's wanted to avoid it. So I'm a little bit surprised. So if you go to the next slide, this is the actual data behind both existing and home sales. I don't know, Jen, if you can go to the next slide. Yeah, there we go. So the white columns are existing home sales, and the salmon colored columns are new home sales. And the new home sales obviously is what drives the home builders, which is the area that I've been fairly negative on for the last 2 years. And I don't see at the moment any sign that new homes are demand for new homes are accelerating. The supply remains very high at close to 9 months of supply. So it's hard to see how margins, which has been the main reason why the home builders' earnings have suffered, how margins are going to stabilize, because they've had to add incentives either through mortgage buy downs or other types of incentives to move product. So the home builders, while they're cheap, they are really cheap. There's no catalyst at the moment to get them to move. The one catalyst came yesterday or the day before, and that was when Beazer Homes was bought out or proposed to be bought out, and the stock was up. I think the premium was 40% over market. So we could have some consolidation, and that could drive some interest back into the home builders. But the basic margin versus volume game still is very weak.
All right. So when you look at a chart like that and you see the, I guess I'm just going to do it from memory since it's not in front of me, but the inventory ticking higher, but it's still around where it was in July of last year. Is that seasonal? Is it, because I don't have any long-term data on something like that. Is it at a level, inventory level, where it's concerning, or is a 1.5 million? Is that I don't know, is that a high number? Is it a low number historically?
We think in terms of months of supply. So existing home sales months of supply in April is 4.4 months. That's actually considered low. 6 months would be kind of average. But if you think of new home sales, the last data we have is from March. That was 8.5 months supply. So that's considered high. So there's a lot of spec inventory for the new home builders that's still on the market that they need to clear in order for their margins to stabilize.
Okay. Sounds depressing, but I'm better forewarned is the best armor, right? So we've been warned. We consider ourselves warned.
We've been in a 2-year bear market. I mean, I literally called the peak in the fall of 24 when I said sell the home builders. I think they peaked in October, November of 24. And they really haven't had much of a bounce. Bear markets can last 3 years, so maybe another year of punk pricing on the home builders. But and they are good early cycle. So let's say we are going into a recession, by the end of this year. Maybe they bottom out sometime in the first half of 27. I mean, that's the first time I would look to buy the home builders.
All right. So Bob, what is $8 a gallon gasoline? Does that hurt the economy or not so much? So we're not there yet, and I understand all of the idea that look, gas prices were higher in a previous administration too, but it's still not what's in the news. In the news cycle right now is high gas prices, and it doesn't. So what say you on this?
So Bob, we should develop an arbitrage. You and I buy the gas and we sell it to David for $8 a gallon.
Well, I was just going to say he rides a scooter to work anyway. So, but
it's a segue. It's a segue. I got it cheap.
I mean, we've been skeptical all along about an agreement being reached with Iran, because we've said from the beginning that this is a lot more difficult situation. This is a religious war for them. They're in it to the death. And we've really not yet seen any cracks in the regime, although there may be behind the scenes that we just don't see yet. But last week, Trump said they either, agree to what we propose or the bombs start flying. Well, they didn't agree. He rejected their proposal. And his comment now is, well, the ceasefire is on life support. And it's really on life support. And it's hard to see Iran suddenly making a U turn and saying, okay, yeah, we'll agree to your terms on our nuclear program and not continue to delay and say that's not part of any near term agreement. And so, do bombs fly at some point? I think the odds of that occurring have increased significantly, not surprisingly to us, because, again, Iran's strategy all along has been to delay, 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 and not try to put anything in any agreement with regard to their nuclear capability. And they came out, I think it was yesterday, and said that a lot of our enriched uranium is buried so deep that even Tehran can even access it. So they sort of continue to flaunt that in Trump's face and say that they're not going to give up their nuclear ambition. That's just something they hold to. I think they'll hold on to the death. And if you look at internally in Iran, you've seen pictures. Their propaganda internally is still ongoing. They've got billboards with big pictures of the Strait of Hormuz with a big fishing net holding all these U.S. aircraft in it. In other words, gloating to their people or trying to portray to their people that they're, giving it to the U.S. and keeping the Strait of Hormuz under total control and closed, and that they're winning the war. So it's a very, very difficult situation. And like we said from the beginning, this is turning out to be a lot more complicated than I think the Trump administration or Israel anticipated. And so oil prices continue to hold up here. Charlie and I, every time we're on together, we sort of have this bet that we take the over, the under on oil prices. And, right here, I'm taking the over. We're at $101 a barrel. I'm still taking the over near term because I don't see all of a sudden an agreement coming out of Iran to say that, okay, we're going to give up our nuclear ambition. You can come in and take all the enriched uranium and all that sort of thing. But I think your only real hope right now is a regime change or a collapse in the regime. And although you see some news articles saying that there are cracks within Iran, we don't see that happening. Is Khomeini's son still alive or severely injured? We don't know. So it's hard to predict, but I think in the meantime, there's still going to be this fear that things escalate, and if bombs fly, what does that mean for the Strait of Hormuz? Does Iran have the capability to really fire off their own bombs or drones and keep the strait basically clogged or blocked? And so it's still a very difficult situation and one that I don't think resolves itself anytime soon.
When you
So
think about the UAE and kind of being their neighbor, I mean, we had talked a few weeks ago of what's the likelihood of this escalating and widening, and so I guess question for both of you really is one, uh, what do you think if tomorrow we have a new wave of attacks that we've decided that that this is taking too long, we're now going to hit several more strategic targets. Is the market down, and by how much, and where is
I mean,
oil?
I can't predict how much the market's down, but what we said last week is I think the range on oil prices, WTI, we're talking about here, is 80 to 120. I mean, I said that last week that if there is a peace agreement by some chance, oil could pull back to 80. If all of a sudden it looks like things are going to go smoothly and opening up the Strait of Hormuz and cargoes are flowing and we're starting to replenish supply, I think oil on the downside could go to 80. On the other hand, if bombs fly and things get complicated and this spreads throughout the region, I think the upside is $120 a barrel on the oil price. We're right in the middle today. We're right smack dab in the middle. But could this conflict extend to some of their neighbors? Absolutely. I mean, I think Iran's part of their strategy, if this thing escalates, is to create chaos in the entire region. And I think part of their view is if they attack their neighbors, that puts pressure on them to put pressure on the Trump administration to reach some sort of agreement. And there were some news reports last week that part of his, decision to sort of continue to pursue some sort of agreement was due to pressure from Arab allies and wanting to reach an agreement rather than have this whole situation escalate. But yes, the worst case scenario is that in Iran, who knows what's true, but they keep saying, oh, all hell's going to break loose if you bomb anything or do anything, and they claim to have more capability than they've expressed so far. Do they or don't they? I don't know, but I do think that if it escalates, they're going to want to create as much chaos as possible, not only in the Strait of Hormuz but the entire region.
So,
Yeah, I
Bob,
mean, to me, when you say things like "just wait, you'll see what we're really gonna do if you do this," I think we would have seen that by now. But
You would
but
you would think so, and it's a lot of rhetoric, but you know, I know what can they do? Where are they getting supplies from? I mean, I read something this morning. I don't know if it's true or not, but that in Ukraine, they're manufacturing 1 million drones a day and killing 1,000 Russian soldiers a day with their drones that they're manufacturing. I mean, is Russia or China supplying Iran with drones? Are they building their own drones? I mean, they've been using drones for a lot of their attacks. Do they have an arsenal of drones that they can unleash? I don't know.
so this is an unfair question, but in your 80 to $120 range, where does the price matter for the equity markets? And I asked that because this morning we obviously got inflation data, and,
Yeah,
and core was at 2.8, which seems to be acceptable, but non-core was at 3.8%, which it
yeah,
gets, you start getting over 4%, and people start worrying about inflation. My banks start off the year thinking you get 2 to 3 rate cuts in the back half of the year. They've taken all of that out of the equation.
yeah.
Um, and then I've heard people say, you mentioned 80 to 20. I think you were talking about the front month. I've heard people
Yes.
say it's more important to watch what's happening to the December and outer contracts, because that shows the expected duration of the higher level of prices. And
Yeah.
80 to 85 is sort of viewed as okay for December contract, but anything above 85 starts to get people nervous. So my question is, in that 80 to 120, where do you think it matters for inflation and equity markets? That's not a
I
fair
mean, I
question
think
to ask.
I think where we are today matters, and I think the inflation data that you mentioned today reflects the fact that higher energy prices permeate a lot of the market, a lot more parts of the market than people realize. And I don't think $100 oil is fully reflected in costs out there today. I mean, the airlines have talked about they're sort of holding back and having their margin impact by not trying to raise prices too much. But jet fuel is 25% of their cost. And so if oil prices stayed 100, and if you look at the December January contract, it's at 80, but we keep pushing that curve out. It's in backwardation, but that backwardation keeps moving out. So the longer we're at $100 a barrel, the more you're going to see more and more impact on costs and inflation, and that matters today. And if we stayed 100, there's more upside to jet fuel prices, gasoline prices. I mean, jet fuel prices and diesel prices have gone up a much greater percentage than have oil prices. But at these prices where we're at today, that matters, and it flows through to a lot of things: people's travel, to you know manufactured plastics and things that we use in our everyday life that isn't fully reflected yet if oil stays at $100 a barrel. So it matters at today where prices are today.
Yeah, and it also matters where that jet fuel is available. So if you look
Right.
at Lufthansa, they canceled flights because they don't have
Yes.
access to the jet fuel. If you look at United Airlines, they actually didn't cancel any flights; they just raised prices because to reflect the higher. So it's an interesting dynamic between Europe and the United States as to who has access to jet fuel. The other play that I've been looking at, I haven't done a lot with it, but are the grains. You know,
Mm-hmm.
partly because they're going to be part of the negotiations between Trump and Xi this morning. I mean, Trump has been trying to push China to buy more ag from the United States, but
Mm-hmm.
you also have higher nitrogen prices because of the Straits of Hormuz being closed. So that means less fertilizer, so less planting. We're supposed to get some data out of the World Agricultural Committee today on plantings. And then you have a drought in the Midwest, which is going to hurt crops. So
Mm-hmm.
I think grains can go a lot higher from here.
Yeah.
Um, and those
Yeah.
are
And,
where,
and it's that there's a big drought in the Midwest.
yeah.
So
And, and that's hurting the
part of
wheat
the,
crop right now.
yeah, and part of the, I don't know how that plays out, but if you have a drought, do they just not plant crops? And then
Yeah, you have
That takes
higher
away
fertilizer
the demand.
prices. You're going to plant less acreage. Then you get a
Right.
drought, and then hopefully you can create some demand from China. I like the setup.
Yeah.
Sorry.
All right,
But,
time to look at
I
some
mean,
BG,
another thing,
I guess.
yeah. So, in the meantime, the thing I'd mentioned on the stocks is we wrapped up earnings last week from pretty much all the names, and the earnings were good. I mean, you had pretty much beats across the board, efficiency gains continued to be put up as far as drilling more efficiently and getting oil and gas out of the ground. And the market not fully having reflected these higher oil prices in the quarter, which is going to be the case again here in the second quarter. So the earnings were very good for the oil and gas companies in that regard. So as far as the stocks, we're not selling anything. We're not writing covered calls yet. We're not doing anything in our positions. And other names that reported last week, our core holdings in EOG, and we own some Devon and Diamondback. I like the earnings from all those names. Those names behind C and Q can continue to be my favorite names among the E&Ps, and then we continue to hold um, Chevron and Exxon and a little bit of Valero.
Got it. All right. Well, let's wrap it up with just a really fast comment on HIMS, HIMS. They reported last night. It was a disappointing quarter. They came out and said, "Oh, look, we're going to raise guidance for the year, but it's always the but." We're going through a margin transition period. We're going from selling our own compounded drug to more of the being a middleman for GLP-1s. We have these peptides that are going to be huge, going to be gigantic. We're not going to be first on the market. Let's see what happens in June when the administration comes out and probably approves the sale of these by compounding pharmacies, which would be great for the stock in the short term. But this quarter was more concerning than that. There are a couple things in the transcript that I put into our subscriber post that I would say were concerning for me, whether they're real or not. But people often give clues on how they're thinking about things and how they say things. So let's talk about a couple of those. So one is that they keep using temporal displacement, which is when you try to change someone's sense of time. So every time, or a lot of the times when they were asked about the $92 million gap loss that came this quarter, they would talk about, well, their guidance for 2030, their long-term guidance is spectacular. And that's fine. There was a cartoon back in the 50s, I think, Popeye, where someone would always say, I'll pay you, if you give me a hamburger now, I'll pay you next Thursday. That's a great strategy if you're in a cartoon. It's not a great strategy if you're a drug company or you're a stock. I don't get fooled by that. I want to see how you're doing now. And this quarter wasn't so great. Margins really compressed because of what I mentioned before. They also talked about kind of revenue recognition, that they're doing a lot of 1 month orders rather than, as they're doing this transition, rather than multi-month orders. So it's shifting from 2 month to 1 month shipments. That means there's a reduced upfront cash collection per order. And that's just temporary. Well, it's only temporary because you think it's temporary. Let's see how that plays out. There were a number of other things that I posted that linguistically that I'm concerned about. I'm not jumping in here. It did, open at $25 and now it's 26, and that's, if you're a day trader, you might say, well, look, people are covering, and there's a huge short position. It's like 35%, I think. The last someone mentioned maybe 30%. And so the volatility around this is something I can't predict, but I will say from a fundamental standpoint, this was not the quarter that really anybody was expecting. The upgraded guidance for the year is fine, but it doesn't offset what looks to be like really stretch goals for 2030. Like that, I don't. Oh, and they've also pushed out profit. They also pushed out profitability from 2026 to 2027. So none of that is good news. And so I'm not trying to buy it here. And I'll wait till it settles down a bit. But that's HIMS. Nothing else for you today. Let's wrap it
Singing,
up.
singing hymns for hymns.
Ooh, I see. I should call you ahead of time. Get all the catchy phrases. Well, with that, it is the 12th of May. You should go to wallstreetbeats.com and subscribe if you're just listening in here and you're a freeloader. We don't like that. Go to wallstreetbeats.com and sign up, or passes.com/wallstreetbeats. And we'll see you tomorrow. I'll see you, Charlie. See you, Bob. Thanks, Jen.